Hey everyone. In today's episode, I'm going to get into trusts and company purchases. Now, let me just make something clear. I have to do this. This is not financial advice at all. I do have finance background, mind you. I've studied it. I have a degree in it and everything like that, but I'm not a registered CA. I'm not a CPA. Please talk to your accountant before setting any of these up. Do not take my word exactly for it. I have to say that here. But look, the reason for doing this episode is simply because trusts and company purchases are a thing that a lot of people talk about. They're a thing that not only a lot of people talk about, but also that people kind of make things up as well and say, oh, do this because of that, do this because of that, and all these various other things. So look, what I'm going to do in today's episode is actually go through my experiences with this and how it can help you, how it may disadvantage you, who it suits, and everything else. So the contents of today is simple. First of all, we'll get into what they are and the definitions behind them. Secondly, the advantage and disadvantages of both. Thirdly, who should buy in these entities and why. And then finally, the types of assets that most make sense. So look, this part might be a little bit longer, but we'll get into it. So we'll start with trusts. What a trust really is, it's just simply a legal arrangement where a trustee holds and manages the property or assets for the benefit of others, known as beneficiaries. Now, there's a few key elements to trusts alone. So first things first, obviously, for a trust to be there, you actually need a trust asset. So what the asset is it's simply the subject of the trust agreement. Now, the appointor, and I'm telling you all of these things because I will get into more detail of different types of trusts and you need to understand what they each mean. So the appointor is the ultimate control of the trust. The settlor is the person who sets up the trust for you. So it's usually a legal representative in that case or an accountant. The trustee itself is the party who holds the asset for the benefit of the beneficiary. The beneficiary is the party who receives the benefit of the trust. And the trust deed is the agreement in which establishes the trust and how it is to be administered. These are the key elements of trusts. Now, probably the most common trust is called a discretionary trust. So all this simply is where the trustee chooses which beneficiaries receive the trust property or the trust asset, should I say, and how much the trust of the property they get, or the asset, should I say. Now, the discretion of the trust, which is why it's called a discretionary trust, is the trustee has the option of splitting up however they like. So that's a key thing about discretionary trust. That's the reason it's called a discretionary trust. Now, unit trusts are a little bit different. Another word for them is express trust. And the reason that it's called unit trust is because they allocate shares in the property or the asset for the beneficiaries in the trust agreement rather than by the discretion of the trustee. So each beneficiary in this case is given an allocation of the trust of the property or the asset beforehand. So discretionary trust, it's to the discretion of the actual trustee. Unit trust, it goes by how many units or how much percentage or allocation each person gets. So that's basically the two main types of trust. Now, you will have hybrid trusts, which are basically a mixture of both. Now, a hybrid trust can go in a number of different forms. So, I mean, people do talk about all these different sorts of trusts, and a lot of them are hybrids. Some are discretionary. In a lot of circumstances, actual self-managed super fund will often be in a discretionary trust, but they can go in a number of different forms. So, I mean, each their own and that kind of thing. But best talk to your accountant about what suits you best if you are thinking about going down this sort of path. Next topic here I want to get into is companies. Now, there's two specific ones I want to get into because there is a bit of a distinction between the two. And the first one is a holding company. So a holding company is simply a company that is established to own shares and control over other companies called subsidiaries. These typically do not produce working assets or anything like that. So they don't produce goods or services, but they hold it on the operation of other companies. They hold it on behalf of something else. That's what they're pretty much there to do. Now, obviously, in that sense, their purpose is pretty much to control assets and provide strategic management over them and protect them against risk over subsidiaries. So it's all they're basically generally there to do is basically I'd say limit and diversify risk. That's generally what I wouldn't say diversify, it's definitely limit and basically control, should I say, ownership sort of structures of different assets. That's generally what a holding company is there for. I'm probably a little bit more biased. I probably prefer a holding company over the next one, which is a trading company. So very simple, a trading company is a business or entity that specializes in selling products, actually trading to basically engage suppliers and consumers. And so they actually work. A trading company is something similar to like maybe you have a warehouse business, maybe you have a cafe, maybe you have something similar to that, something along the lines of that. Now, as I said, they typically specialize in purchasing, financing, and doing various other things to actually trade. So a trading company is simply a company that trades. A holding company is one that holds. There's two different things. The holding company holds the asset. Trading company simply trades whatever they do. Now, the key distinguishment between the both of them is the trading company will generally have a business within it that's actually trading it, whether it be products, services, or whatever it is. The holding company generally doesn't. It simply only has, but it's only set up to hold the asset. That's the key difference between both of them. So that's the key different structures of, I'd say, the main ones, should I say, of companies and trusts. Yes, there are different ones. There's hybrids of both of them. There's different structures, corporate trustees as well. I'm not going to get into that because it is quite complicated to explain, and it's also quite different to each scenario. It's also, it depends on who the corporate trustee is and what you kind of want to do. So all of that is very different things, but the fundamental main two are discretionary and unit trust, and the fundamentally two main companies is a holding company and a trading company, and that's the key differences between both of them. So obviously, talking about both of these, there's key advantages and disadvantages to both of them. So first things first, we probably want to get into trusts. And now this is going to vary slightly between the two of them. I'm not getting into massive detail because, again, this isn't financial advice, but if you talk to an accountant in your situation, they will, a good one especially, they will be able to give you the right advice. Now, I have numbers of them across the whole country who can give you the right advice via this. I've obviously got plenty who help me alone. So the first main advantage of trusts is asset protection. So in a lot of circumstances, you might be in a high risk job. If you're an anaesthetist, for example, right, and you're looking at an asset longer term, and you might have multiple, and someone could very much so come after you, and you don't, and let's say you don't have the right, maybe you do have the right insurance, but you still worry in that case. Trust can really protect that because the actual holder might not even be you, so they can't actually come after you for it. Tax efficiency is another thing. So, tax alone with trust does work differently to a normal, so should I say, purchasing it in your normal name, should I say? It does work differently, and you can distribute it differently as well, so you can obviously limit taxation for those reasons. Again, talk to an accountant about that. Estate planning, passing the assets on to your next generation is really important as well. Quite easy to do with trust, especially if it's set up properly. Privacy and flexibility. So trusts do have privacy in the sense that people often will not actually know who the actual asset holder is. They won't even be able to find it out via any way means necessary unless they go do some very deep digging. It's a lot of circumstances they still can't. I remember studying, and this is for anyone who studied law before, they'll know this, Carlisle and Carbolic. It's basically nearly everyone who studied law would know about Carlisle and Carbolic, the foundations of contract law and all that kind of thing. Not that it's trust, but you get into deeper legislation, learning about basically a family, and I can't remember the exact name, but there was a family basically in the UK. This is like 400 years ago, who had assets that, should I say, protected that even the state or the government at the time, so it would have been the empire at the time, couldn't find out who owned it, and they never got them for it. So, in those circumstances, trust can be very good, and flexibility as well. There are things you can do with trusts that are very good, and they're quite flexible around what you can do, granted it's set up correctly. So that's the reason you need to talk to the right accountant, because they will know this kind of thing very well. So that's a bit of the advantages of trusts. Complexity and cost is definitely the first disadvantage. Now, I'd actually argue, in my opinion, complexity isn't that much of an issue if you have a good accountant or good financial advisor or commercial lawyer who could set that up for you, for example. simply because they can break it down in an everyday solution. But cost is definitely a thing. These costs thousands of dollars a year, and they're definitely not for the average person all the time. Losses can be trapped as well. Now, why I say that is because if you have losses in trust, it is actually a little bit more difficult to, should I say, transfer them, account for them, borrow against it to be able to get through it and that kind of thing. So you need to be really secure in what you're doing if you're buying in a trust. Borrowing limitations and limited control. Borrowing limitations is simply because if you're buying in a trust, not every lender will like it. Not all lenders actually even lend to trusts. A lot of them shave lending off trusts. There's all these various things that go on there. So that's something that is a thing. You'll notice that just by talking to a broker. Just ask them how many less lenders will borrow to a trust. He'll probably say most will do it, but he'll then ask you to define what trust you're doing, and that'll limit it further. And not only that too, it's not all. So it's going to, depending on how complex your structure is, will depend on who will do it. And generally the rates are also a little bit higher. Limited control. So the whole premise of setting up a trust is whoever is actually holding it on behalf of you better really trust them. That's the reason it's called a trust, and you better have it very well written out, because you don't have 100% control. You have a lot of control, but never entirely 100%. And you want it to be, you want it to be a very good relationship, whoever has this. Finally, there is a shelf life to a lot of trusts. So this will vary state to state. For example, I know South Australia has a longer shelf life than, for example, New South Wales. So that's something to consider as well. You could probably argue it's not necessarily a disadvantage, but some people would view it in this way. But anyway, companies, let's get into that. So the main advantage is there's very limited liability if it's set up correctly in a company. You can distribute it quite well across people or across different, should I say, entities or assets as well. And it's limited to what you have. Access to capital is actually a very good advantage to it. So you can do this with trust as well, granted it's set up in the right way, but you can effectively limit, not have unlimited, but almost have unlimited borrowing power if it's done the right way and you buy the right assets, because an entity, a company or trust can take care of its own debt obligations. So you have the right, entity structure, you might be able to actually get that sorted very well. Now, in saying that, it's not completely unlimited. It has to be done the right way, and this can change very quickly. So again, talk to an accountant about this. Continuity. So again, passing it on, you could probably put that / estate planning down. Passing on to the next generation, quite easy to do with companies as well, especially if it's set up in the right way. Flexibility and ownership structure. You can hold different, holding companies is a good example, different amounts of percentages of companies. You can be the sole shareholder and actual director of companies. You have definitely flexibility in this. So all of those are good things as well. Clear disadvantages, cost and complexity. Again, it is more costly and complex to do. I'd say complex wise, again, like trust, it's probably not that complex if you have someone who knows what they're talking about, can explain it very easily to you. So, but cost is definitely a thing, no doubt. To add to that, compliance and reporting, companies do have more reporting they need to do. So keep that in mind. Double taxation, you don't get in companies the 50% capital gains discount in companies. It does not exist. You don't get negative gearing in companies either. So just keep that in mind. That does not exist. Again, talk to an accountant about this. More formalities. So you might even have a company constitution or a draft document, something similar that you kind of have. So, that's a really important thing as well, just to keep in mind. You want it to be really down packed, and if you're doing it with someone else, you want it to be absolutely down packed. You probably want it even to be reviewed by a lawyer. So if anything were to go wrong, they at least have legal oversight of it to give you an idea. Finally, there's still some risk exposure. So people can come after you in different ways in companies to give you an idea. So, there is still risk exposure. Each of these are going to suit different people a different way. So some people a trust might suit them better, a company might suit better, but each their own. Again, I haven't done advantages and disadvantages for the difference of discretionary trust, unit trust, or hybrid trust. This is as general and it's the same as a holding company and a, trading company. They're different as well, but generally these are your advantages and disadvantages for both of them. All right, let's get into who should buy in trusts and companies. And again, consult your accountant first. I'm not a financial advisor, but this is just from personal experience. So please go consult one. The first one really is professionals and business owners. Now, the reason for this is mainly because generally you'll have a job where you might be earning a decent amount of money, but there might be a fair bit of risk exposure. So a good example of that would be a doctor, anaesthetist, maybe a lawyer. It might even be someone else, for example, it could even be someone in even the engineering and construction game, for example, who runs a business. Now, there can be a lot of risk exposure in that, and if something were to go wrong, someone could genuinely come after you. So that's a really good reason why someone you might do that. Families are another good example. So families, and it's mainly families because if you're looking longer term and looking to pass this on to future generations, trusts and companies can do that very easily. And it's also if they become quite, positive in the sense of making quite a bit of income, you can distribute income based on how you want to, especially if it's in a discretionary trust or a company, because it's technically its own entity that can pay out people from that. So you might, pay it to a child or something like that, or various other ways. High earning individuals. So again, I say this as well because if you earn a lot of money, you probably want to set it up in a way where if anyone ever comes after you again, you want it to be protected. So high earning individuals is probably another one of them. Very important in that way because, a lot of these you kind of guys, are those professionals and business owners? So that's another thing. Are those wanting to build portfolios? Now, the reason I say this is because accounting-wise and finance-wise, it's actually more a lending probably tool more than anything. So what I mean by that really is trusts and companies, you can have them to be self-servicing. So talk to a broker about this who's good if you know what I mean. Well, not if you know what I mean, but if you know what I'm talking about. An entity such as a trust or trading company can self-service. So you can retain borrowing power and not wipe debt, but wipe the view of debt against your name in the future, granted you have the right asset. So that's another thing you just might want to consider. Those wanting to build larger portfolios. It's probably, for me, I'd say professionals, business owners, high earning individuals, families, those wanting to build portfolios. If you sit in all of those categories, you better consider this. That's what I'm saying. So singles are another one. I say that now simply for asset protection purposes as well. Now, if most single people probably will have a partner at some point in their life. Now, if you set this up in, let's say, the right trust or something like that, it probably will, I'd say, protect you in a large sense. Now, I'm not saying it'll totally protect you completely. Now, that would be a complete lie because there are still things that can be brought up if someone comes after you. There are still costs associated if they do as well. But you'd rather protect the asset you work so hard for. So that's another thing for singles. And it's just also, it gives you, knowing that you're at least protected will probably give you a bit of a better mindset behind it as well. You don't want to be going around, thinking everyone's coming to get me, thinking that, if you're protected legally in the best way possible, and you're protected financially in the best way possible, you can live your life pretty happily and not think of kind of the worst case scenario in every circumstance. So that's probably another thing. Those wanting to minimize taxes. Now, I'm not saying this so, people hate me for it and say, oh, you don't pay tax. Big companies don't pay tax. But I think everyone needs to pay a level of tax. But I think we'd all agree that it's not really spent very well in this country. So, I'd probably, if you're legally doing a perfectly fine thing and you're looking to minimize it, should I say, I'd say also not even minimize it, it's probably the wrong word. I'd probably say best use the money that you have coming in and the actual assets you can purchase. Both trusts and companies can be a very good reason for that. So, I'm not trying to piss anyone off who loves tax or anything like that. I'm sure most people watching this channel don't, but all I'm saying is best use what you have and best use your assets to the best of their ability, and ideally use the money you have coming in on stuff that's going to best improve your life. So trust and trading companies in many circumstances can do that, and they're also an insurance policy for you in a large sense. So people take out car insurance where you're only protecting generally an asset that's like 30 to 50 grand, but for homes, they're usually like, 700,000 plus. In Australia, probably around $1 million on average these days, right? So what I say to a lot of people is, if they haven't spoken to an accountant or a commercial lawyer or anything like that, is, well, you have car insurance, don't you? And they always say, yes, I do have car insurance. And then they say, oh, but I don't want to spend $3,500 or $4,000 setting this up. And I'm like, okay, so you're happy to spend, let's say, $1,500 to $2,000 or whatever it is on car insurance for a $30,000 asset, for example, right? But you're then not happy to spend $5,000 to protect literally probably 85% of your livelihood. And now people don't think of it that way, but that's how it should be viewed. So that's another thing I'll say. And that relates to all these points. The final one is self-managed super funds. Now, I didn't want to add this, but then I'm like, yeah, I do. It is what it is. So, self-managed super funds really is, people who are buying, obviously on behalf of the self-managed super fund, you basically do create a bare trust and a company, and basically that's what you do. You have a trust and a company for self-managed super funds. So if you're buying a self-managed super fund, you have to set this up anyway. So I'm adding it to this because people who are looking to do that won't know that. So that's basically how this kind of works. So those are basically the people who should be buying in trusts/companies. Now, I'm going to get into a few different things, and I'll explain why these are good assets for different purposes. So the best assets to buy in trusts really are a couple of things. So the first one is blue chip properties. Now, the reason blue chip properties are important to buy, I should actually say trusts and companies to this slide. It's not only trusts. The reason why blue chip properties are good to buy in this structure is because generally you have higher working professionals living here. They're generally worth a lot more money. Hence, the risk exposure to you, if you don't have that, is significantly higher. So that's the reason why these are good to buy in. These are good to buy in trusts and companies. That's the first one. The second one is dual income properties. Now, dual income properties is because the reason being is because it's particularly for a servicing aspect. The reason for that is because, as I said, banks and certain financial institutions or lenders can see them as different entities. So because they can see them as different entities, what you can have there is, very simply speaking, it is as I said, very simply speaking, them self-servicing in the future, them basically limiting the debt or wiping it against your name, and you retaining a similar borrowing capacity to before. Granted, interest rates haven't changed. So that's the reason. It's mainly a servicing and financial structure purposes. So that's the biggest thing behind this. Thirdly is property development properties. So if you want to do a development in the future, it comes with a significant risk. I recently spoke to a very good accountant I know. He actually is an international accountant as well, and he actually is he actually speaks on behalf of the Building and Construction Society of Australian Code of Australia, to give you an idea. So he's very well versed, should I say, in that. There is inherent risks with this. The bigger the development, generally, the higher the risk. And also, if you don't know the builder and you're hiring someone off the street that you don't know personally, there is a lot of risk with that. So that's the reason you do it. It'd be to diversify and ideally, not diversify, sorry, it'd be to limit risk on what you're doing. Multiple party properties. So there's plenty of people these days, due to the course of how expensive things are, where you do get quite a few people that get, have to join forces to get in the market. Now, that's a fine thing. I'm not having a crack at people like that. But the reason it's important is because you want to have either a constitution or something similar, a trust deed possibly, to actually have this set up right in case anything goes wrong. So I would not buy with a friend. It's probably different if you're buying with your partner and you've got kids, because that's probably fine. But if you're buying with a friend or a relative or someone else, that's the breeding ground of something going wrong, to give you an idea. So that's definitely one. Unit blocks. That you'd probably add that under dual income properties. This is probably multi-income properties I'm talking about here. Unit blocks are very much so an asset where, if you have, multiple parties going to own it, or not only multiple parties, but multiple parties even leasing it, which you always do on unit blocks, there is more risk. So you probably want to limit that risk by having it in a trading company or trust. And also, not only that too, it's probably going to be self-servicing over time as well. So it's probably a finance perspective as well. To add to that, cash flow focused properties, you can probably add the unit blocks, dual income properties to that. Some are even single front dwelling cash flow focused properties. It might even be one you flipped and turned cash flow neutral. It might turn cash flow positive in 3 to 5 years. Most do in good locations, or even 3 to 10 if it's a very expensive area, but they do. These properties, again, it's probably more a servicing based reason for that, to keep your borrowing power, should I say, fairly intact, and also not only that, to actually structure it for a method of protection. So those are all good reasons why these are your best asset types to purchase in trusts. I'm actually going to do a little addition to this, and I'm actually going to say the regions you should purchase in trusts and trading companies. The reason I want to say this is simply because these areas are by far your best areas to purchase, and the areas I purchase in alone. So in no particular order: Melbourne, Sydney, Newcastle, Geelong, Central Coast, Wollongong, Brisbane are all your best locations to purchase these assets in. And the reasons for this is because they are predominantly areas that perform well, predominantly the areas where you can get all of these things I'm talking about done very well, and predominantly the regions that will do well long term and actually change your financial future. Secondary locations are probably the Gold Coast, Sunshine Coast, Hobart and Perth. I know people might say Adelaide and Darwin. I don't purchase in these locations, so don't even think about it if you're going to talk to me about it, because I just don't purchase in these locations. But look, that's basically my summary of today's episode. And look, I really thank everyone for supporting this channel. I mean, I've got like more than 3,500 subscribers, and it's going very well. I'm very happy with where I'm at. I know people reach out to me and say, oh, you know, you could do more, this and the other, but I'm happy with the good viewers I have. I'm not really fussed about having 100,000 people following me. I actually don't want 100,000. I'll probably be happy with 5 or something like that of all good quality people that follow it. But anyway, if you're serious about getting in the market and you're looking for a buyer's agent and take better care than any one of you, please reach out via www.compoundinvest.com.au/inquire. What happens here is it's simply a not quick, but it's in detail, I should say, 30-minute discussion between myself and you. I give you a phone call and we discuss what you're looking to do. I'll give you some options and we basically formulate a strategy from there. Now, if you're someone who's looking in the next couple of months or so, or it could even be 3 to 6 or 12 months or something, or you're someone who's sitting on the fence, doesn't like the idea or doesn't know much about buyer's agent, wants to know a bit more, or has heard bad things about them, look, I still suggest you reach out, because you'll get a feel from what I'm like. You'll know I'm a straight shooter. You'll know I really take care of people. And pretty much, you know, I'll explain everything you need to know. And it's still important because the strategy itself is more important than the purchase, because I can't tell you how many people I've heard reach out to me and say, I own a property here, there, and everywhere. One's in Albury, one's in Wodonga, the other's in Dubbo, the other's in Geraldton, the other's in Mount Gambier or something like that. I'm like, I would sell all of them and buy 1 or 2 good ones, because there's no point of holding crappy assets, right? And it's funny because I even get people reach out to say, oh, but this person told me to buy here. This is a really good asset. It's cheaper than everything else. And I'm like, yes, it is. And yes, you will make money on the way in, but I still wouldn't buy it, because if it's in a poor location, nothing else matters. The location takes care of nearly everything. It takes care of the capital growth, takes care of the tenant you get, takes care of the long-term rental growth, takes care of the tenant's ability to stay long-term, takes care of the future neighborhood, takes care of the future long-term residents, also takes care of the hold rate, takes care of everything. So that's why it's very important to get this right. So again, anyone who's serious or looking, www.compoundinvest.com.au/inquire. Look, I thank everyone again for watching so much, and I look forward to seeing you all in the next one. Have a great week ahead. Thank you.